Hey, good evening. I'm sorry. Good afternoon, guys. I'm looking at Tezos. I believe will be a powerful um, cryptocurrency. All right. So remember we talked about the Fibonacci's extensions and retracement, and how they're very important for us to trade. Now, Tezos right now is trading at. Um, Let me look on my phone. Actually I'm in a bar replay right now, so the price is not showing up until I hit the button. But I want to show you guys by going back in time had we measured this particular move. Okay. All right. Tezos is at $2.84. So we're gonna measure this move right here. All right. You see from here down to right here. All right. That's a what? Impulsive bearish move. Remember that term. Impulsive means we got a wave we're moving somewhere. Okay. Now you look left, we also have another impulsive move here. That's called an impulsive bullish move. All right. However, this move down made this impulse somewhat invalid. All right. Now I'm looking on this chart. I see some form of manipulation somewhere on here, and the reason why is because you can't. I'm not even going to scroll all the way up here, but look at this red line. This is a wick. That means something happened overnight where it just skyrocketed up. You never know. Somebody probably made billions, millions of dollars off this particular move. Um, that's one of the things you have to keep in mind when you're dealing with, even in stocks. It doesn't matter. Stocks, cryptocurrencies, forex pairs, whatever. You got a massive group of what they call whales or the market makers that's behind the scene, and they're getting away with things like this. Okay, you clearly see that this is a red line, which means there's a wick. All right, we got this right here as well too. Okay, look at this, February 9th. All right, I hold Tezos. This thing went all the way up to $9. Right, but it probably spiked up so fast and came back down. Guess what? Somebody had an order. All right, they got executed at that price. We missed it. Okay, so sometimes that happens. So what you would do is, it's called arbitrage. Sometimes people, what they would do is they would buy an asset like this and they would just set multiple levels of selling, and then they'll set multiple levels of buying, meaning that if price spikes up, they sold and made a lot of money. If price spikes down, they get filled at that price. Some people do that. All right. I don't really waste my time doing that, but it can be a smart thing to do. All right. So listen. So at this time, uh, Tezos had spiked down to 90, 97 cents, 90, 95, 99 cents. All right. You see to the left, 99 cents. Okay. We can measure this move using our fib extension. Take from here down to here, back up. Okay. All right. So 29 cent, 14, all in this area, price could come up into this area. Here's the thing. You probably would say, Eric, you're a fool to think that price is going to go that low. The thing is, we have to honor it. It don't have to come this low, but you have to honor it that extension could be played out. And that's how you're going to learn how to start respecting the markets, okay? So this price area, it could come down in this area, okay? So what we're going to do is we're going to do a bar replay, and we're going to see whether or not price would have came into this area, because what we're taught to measure this move, set a box there, and say, hey, this could go. So we also can do the same thing up here from this particular move, okay? So, and we clear this move, sorry. This move hasn't played out yet, this move. fully. All right. So we're looking at eventually a $5, $6 target for Tezos. All right. Okay. So eventually, price will eventually come back up in this area. Right. So let's go ahead and just play this bar and let's see what happens. Okay, here we go. All right. Boom. You just missed it, but it hit it. Let's zoom in. Remember, I didn't. I mean, I'm not. We're not. I mean, I'm not saying this is not like a crystal ball or anything, but clearly, y'all see this spike down. Somebody came down in here and hit that target. Okay, I want to let you guys know. Anytime you have derivatives, all right, a derivative means it derives from something else, meaning that right now in these markets, you have people who can trade Bitcoin, they can trade, Tezos, XRP, even all right. When we trade in currencies, do you own the currency? I don't own any Japanese yen, but I can trade it. I don't own Canadian dollar, but I could trade it. That's called a derivative. All right. You got people out here who don't even own cryptocurrencies, but they're making millions of dollars off of it because they're trading in what they call derivative markets. That's essentially what Forex is. Options trading. You don't own the options. You may own the contract, but you don't own it unless you exercise your option to buy it. But you don't own it. So that's part of the derivative market. So anytime you have an asset that's involved in a derivative market, you're subject to all forms of strategic manipulation where people want to take prices and swing it into their favor. They don't care about holding an asset, right? Over time, the asset will do good and perform well, like Tezos will perform well over the time horizon. However, in the meantime, you have people who can take advantage. See this wick down, and it came down into our green box. All right. So imagine if we was holding a derivative futures contract or whatever, and we set that this was going to be our target area. This move right here could have made somebody thousands, hundreds of thousands of dollars. Okay. We didn't even see it happen. I just happened to go back on the chart and look at this, but this could have been it could have went down so fast. All right. Also, you'll say, well, Eric, why would it drop so fast? Well, imagine if you have what they call a lot of long positions in play. Long means you think the price is going to go up. So on the derivatives market, you have a lot of orders to take it long. Well, guess what? There could be too many people who are going long. So if there's too many people going long, how do you shake them out of their position? You take the market low, knock them out their stop losses. Okay, and when their stop losses are knocked out, what do? You're collecting all the premium on all those stop loss orders. So those orders become collected, and then now you can pay who? The winners. Now you can pay some of the people who are long. Okay, because not all the long positions were activated at that time. Some people now they figured that hey, now I can get in, and guess what? The market makers don't mind paying you now because there are more net long. There are less net long people in the market now. Okay, so when you learn how to trade, you want to follow the market makers. You want to understand their psychology. All right, like they say, you don't want to be the popular kid on the block. All right, so look, we got a lot of buying pressure, so we're good, but we also the key level of resistance. What is the level of resistance that we're at? All right, if we pull up the Fibonacci retracement, we're at the 78%. Okay, we're at the 78% zone. Sorry about all these ads. All right, yep. So we right. Pull down a little bit. All right, yeah, we've reached it a little bit, but this is a key area of resistance. All right. So we could come up here and we can retest this area up here to $3 some change. All right. And Now, what we can do is we have what? This extension, this move right here is over with. Why? Because this extension was hit. So now we're looking to the upside. So since we're looking to the upside, what are we measuring? We're measuring. So you you can measure down here, which we probably just need to. We need to go ahead and measure hit this because this is part of the move. This is all part of a bullish move. Why? Remember, it came down and then it went back up. You have to consider this as part of the wave. All right. So essentially, we're measuring from this point all the way up to this. All right. So we're gonna pull up our fibs and we're gonna drag it from the bottom to the top. All right. Okay. So if price rejects in this area, we have this whole area to play with. All right. Here are some loading zones that we can look at. If price does not break this level, we can get pulled back to the what? 23%, which is at $2.22. We go to 38, 182. 50 cent, we had 149. 61%, we had $1.16. 78%, we're at 69 cents. All right. Price can come back all the way down up into these areas. Okay. Now, a key level you need to look at is this what? This golden ratio. Only reason why you want to look at the golden ratio at $1.16 is because what? You got to look left, and that is a key area of what? Market structure. All right. Look at this area right here between $1.03, $1.16 area. This is very important. Okay. Also, the 50% is what? Very important. $1.49. This is potential loading zone. And then here, see, market structure. All right. Your Fibonacci is nothing but support and resistance, guys. That's all it is. Don't think that it's some type of magical tool where it's going to automatically just give you profits. Use it in conjunction with looking for confluence in the market. Exactly what you're looking for. All right. So these are loading zones. Would I buy this right now? No, there's nothing to buy. All right. If I was day trading, I would have bought it what? As soon as it covered my 20 MA or right here. All right. Here's an opportunity right there. So all these are buying opportunities. Boom. Right here. Buying opportunity. However, people who bought here came up and then what? Boom. Got stomped out of their position. Okay. So that's what could happen on a derivative. So Forex markets like that too, to spike in one direction and take all the long positions out. Okay. That's why they say it's key to have stop loss. This moves so fast, it could have blown through your your stop loss. I'm not sure. This is one reason why some people like to just trade into the futures market, because then they feel like the futures market is a little bit more organic and it's not subject to getting wiped out since you're on what you call, I guess, a time stamp type of contract. You know, you got an expiration date. So that's why some people like to just deal with futures trading. So that's Tezos. Did a quick video. I'm gonna do some more videos today, and I'm gonna upload them. All right, you guys should have a great one.